Geopolitical concerns, tariffs, and some softening economic data continuing to pressure equities, which have now hit the 200-day moving average. We'll talk about a couple names seeing unusual volume and also take some questions today on open interest. Hello everybody and welcome. We're going to get to some unusual volume and questions, but first we continue to get a drip of softer looking economic data. For example, construction spending came in a tenth worse at minus 0.2%. ISM manufacturing was light at 50.3 versus 50.7 on the survey. And I am hearing some music, so as if we're going to the end of the show. And I don't know if you guys can hear that. Hopefully not. Okay, I think we're getting a little bit of music, so we're going to hopefully get that to stop somehow. Or you can just enjoy it. All right, so, now we're not getting played over. You know, a lot of people like to talk over me too, so I'm not surprised that the music didn't want to hear some of the bad news that I was about to deliver. So ISM new orders came in at 48.6. That's versus 54.6, which is the survey consensus. We also saw the ISM employment numbers come in slightly light, 47.6 versus 50.1 in the survey. Construction spending. And the only thing that really was higher were the ISM prices paid, and that's not necessarily what we want to see. In addition to that, so I was going to be going on Fast Money on Friday, and I ended up not having that hit. And the reason I didn't go on was because, of course, what happened in the White House between Ukrainian President Zelensky, J.D. Vance, and President Trump. And the market actually didn't respond that unfavorably to, I think, what we can all agree was a pretty ugly press conference there. Now, what I'm about to say, I'm going to be speaking a little bit extemporaneously here. So what I'm about to say is quite incomplete. Let's begin with that. But there is a long history here. Whatever side of this you happen to come down on, there is a long history here that really, in some ways, dates back to the end of the Second World War. But the most important point that I would like to just bring up as we think about what happened there a little bit and what the potential implications are in terms of geopolitical risk, security. I think we actually saw an uptick in some defense stocks, for example, is the following. And it just so happens that when I was at Tufts University, that was during the collapse and ultimately the dissolution of the Soviet Union, and I happened to be studying the region at the time. And an interesting thing that we should all contemplate as we look at what's going on there, and there's a whole lot of other stuff that we could get into, but we're not going to because this isn't a political show necessarily. If we want to have one of those, you guys can let me know and we'll set it up for another time. But basically, when the Soviet Union dissolved, and we had a whole new rash of independent states, some of them that actually had possession of the Soviet Union's nuclear weapons, and obviously it was very important in the tumult that followed that to sort of denuclearize those regions. One of the things that happened, the Warsaw Pact dissolved, but NATO did not. And when then President George Herbert Walker Bush and Secretary of State James Baker were speaking to first Gorbachev and then Yeltsin, and there was a lot of concern about how this whole thing was going to go and what should happen. There was essentially an understanding that was reached that that Ukraine would denuclearize, that Russia would not invade Ukraine, and that NATO would not expand eastwards. Now, I'm taking this at a very high level, and I encourage anybody who's interested to look into this a little bit more closely. Now, because all of this ends up having implications on what's going on now. One of the things that was discussed then, and many, many times in the 30 years since, was whether or not the fact that NATO continued to exist and actually did take in new former Eastern Bloc countries as members, but not on the Russian border, whether any or all of these were were provocations as far as Russia was concerned. We know that both Putin and Lavrov had many times said that Ukraine joining NATO would be, was crossing a line that they had drawn in the sand. I'm not trying to defend Putin by any means, by the way. I want to say that I think we can agree that it is not, he's appointed himself president for life. There is plenty of evidence that he's done some pretty horrific things in his position of power and also to maintain it. Seems like Russia is a kleptocracy. This is not just the United States position on this. There's plenty of evidence of this all over. But it is curious because in the midst of all of that, we had a potential deal on the table. First, there was a deal right after Russia invaded where Ukraine was going to commit to not joining NATO because that was part of the provocation. Zelensky had asked whether he could join NATO, and the United States, Jake Sullivan, and the Biden administration didn't deny that unequivocally, which they probably should have. And that deal ended up falling apart, and then there was a new deal, essentially a commercial minerals, rare earth minerals deal between the United States, because the United States saying that we would put boots on the ground or that Ukraine could join NATO would be a further provocation, because essentially you're putting NATO right on Russia's western flank. So it's a little bit curious how this whole thing played out last week, because we know that a negotiation had essentially led to a deal, as much of a deal as could be announced at that stage. And my own perception is that one does not go into the Oval Office and essentially hijack a press conference to make an appeal directly to the U.S. citizens, which I think is what Zelensky was doing. And that was, how that was handled thereafter. I think J.D. Vance said that it shouldn't be litigated in front of the media. I think that was right. I also think that diplomacy always requires sensitivity and tact. My preference might have been simply that they had said, we're going to have to, take this offline and have a conversation independent of this. But that's not what happened. So I'm now hearing that Zelensky is prepared to go along with the deal that he had already said he was going to go along with, that he did not sign when he had the opportunity on 2 occasions in Europe or when he was at the White House. But here's hoping that that happens. And I want to make one further point before we move on, and that is that there is a lot more additional nuance here. And there's plenty of people who are suggesting that the new administration is abandoning many, many decades of commitment to using soft power abroad. And, whether you're talking about USAID or other things that are going on, I think there is another way to look at it, and that is that there have previously in the United States been efforts to not use overt or kinetic power to advance the interests of the country. And sometimes the people of the United States have not been happy about learning the kinds of things that we did to exert that power and influence. And I think that that's essentially what we're seeing now, is that there is a pendulum swing where the efforts to promote, is it hegemony? Our interests don't always align with our values. And I think that's kind of what's going on here. My hope, of course, is that people recognize that sometimes we need to negotiate and deal with people we don't like. That's whether that is Putin, whether that is MBS in Saudi Arabia, who has himself done some horrible things and so on. That is the nature of diplomacy. And if people recognize that, then hopefully and rather than turning this into a shouting fest and a battle here in the United States. That's what I'm hoping we manage to avoid, because it seems like this is also being turned into some kind of a partisan bric-a-brac. So, okay, let's move on with that little side note. I have a feeling there's going to be a lot more to discuss and talk about in that area. But what I wanted to do first, before I get to some of your questions, was just look at a couple of names that have seen some unusual activity. And one of the things I think I have failed to do in the past was help you all figure out what it is you want to look at or how you want to look at to sort of figure out what's going on. So I picked a handful of names where we're seeing some unusual activity, and I wanted to just show you how you might think about what's going on. So I often will take a look at names that are seeing unusual volume, and that's sort of my first look. So Cigna, ticker Charlie India. Let's see, it traded... It's one of the names that's actually up today. It traded about 4 times the average daily call volume, or thereabouts. Trades, the 20-day average is about 1,250 calls, traded 5,353 today. So taking a look at this, one of the things that you should always care about is it opening? Is it closing? Were they bought? Were they sold? Then, once you've established that, you can then move on to try to figure out, okay, well, why was that happening? And is this something I should really care about? So I figured I would just take a couple of the names that saw unusual volume, walk through this, and take a look. So here we are. All I did was I just went into the net flow section here. Now, I don't know, what your broker platform, if your broker platform allows you to take a look at these types of things, how it's going to show that. But the first thing we're trying to do is establish, were the unusual calls, which ones were they? And it turns out, if you can see my cursor here, it is the April 340 calls, 4,100 traded. And we know it was opening because we can see that the open interest was only 238 contracts. So the next question we have is, okay, were they bought or sold? Because if somebody has a big stock position and you see all these calls trading, is that bullish? Well, not necessarily. It could be an overwrite, or it could just be a naked call sale. And one of those positions takes a bullish position and makes it somewhat less bullish. Another version, if you're just selling naked calls, is neutral to bearish. But if it's an opening buyer, then that is bullish. Does that necessarily mean the stock's going up? No, but we care because this is where institutions are actually committing real capital to make bets with a specific target in mind and a specific date in mind. And what we can see here, happily for us, now there are other ways to do this. Happily for us, unusual whales gives us a little bit of a shortcut because we can establish by looking at these whether they were bought or sold, and we can see on the net premium side that these were actually purchased. So if they were sold, you would actually see the net call premium going down rather than going up. Okay, so what could potentially be going on? Because we saw that, on a pretty sharply down day, Cigna was higher. And, it should be said that some of these healthcare insurance provider companies have been under significant pressure. It was a great performing sector for quite some time. In fact, actually, I'm just going to pull it up over here. United Health is probably the best known one. But then you've got Humana and Cigna and other players in the space. And obviously, they did not do well in 2024. We had the murder that took place in Manhattan of the CEO of United Health, the insurers support, not the whole United Health group. And then, of course, the big news was that they were going to investigate whether or not there was some improper billing going on. And so also the pharmacy benefits managers, have all been under a significant amount of pressure. So if we just take a look at the events calendar for Cigna, one of the things we're going to see and this was sort of what I wanted to take a look at, what are the potential catalysts that exist between now and April expiration? And one of the things you're going to notice immediately is that earnings is not among them. But they are going to be participating in this Barclays Annual Global Healthcare Conference. That is going to be coming up just next week. This is next week, right? So today is so it's going to be next Wednesday. And it's quite possible that this is what they're taking a look at. So I just wanted to bring that to your attention. Things to think about. We can see that, after having a really pretty miserable year, we have seen a rebound that has taken us through the 50, through the 100. We're probably getting close to the 150, which is, my friend and colleague Carter Worth's. And yeah, so this is the 150. So we're kind of approaching that. But, this is one way to take a look at it. We have unusual activity. It's not earnings related. So that's a circumstance where you want to take a look and say, okay, is there something else that they could potentially be targeting? Let's move on to another one, just as an example. And I think it was Steve Grasso on CNBC a week ago or so, where he was taking a look at some of the exchanges and suggesting one might want to take a look at those. So once again, here we're looking at ISE. ISE is the Intercontinental Exchange. ISE traded average volume is about 2,350 contracts. That's the 20-day average, give or take. 5,140 today. Big unusual call volume. And I thought this would be a really interesting contrast to the Cigna situation. So we take a look and we see that the most active contract in this case are the January 2027 160 calls. Two things to think about. One, the open interest was 4,377 calls, as we can see over here. Second thing is, and Unusual Whales is telling us these were sold, but even if you didn't have access to a tool like this, which would give you that indication that actually this is not a bullish bet, this is very likely closing activity on a previous bullish bet. There are some other things, if you don't have a tool like this, that you could look at and it might sort of tip you off a little bit. And one of those is the fact that it's the 160 calls. Now, sometimes people like to buy long-dated leaps as a proxy for being long the stock and having some leverage. But the point I would make here is that actually ICE has had quite a big rally lately, right? So we can just take a quick peek, and you're going to see that if we, we'll go over here, we'll go to Ticker Explorer, and we'll just put the ticker in. You can see what's going on with the stock. All right, let's switch that over. What you're going to see is that the stock has had a big rally. In fact, those calls had been purchased just recently. So we can deduce from that one, the stock was below 160 when they were purchased. Those were sold. Very likely that's profit taking. Incidentally, these little curves that you see here are the options implied move for Intercontinental over this short window. All right. Another name that had kind of a similar situation was another exchange, and this one also had unusual flow, so we'll just take a quick peek at CME Group and see what was happening here. And we can see that it was, once again, long-dated calls. What do you want to bet? It was the same trader, right? Institutional flow in January 2027 calls in two exchanges. So very, very likely the same institutional market participant and very, very likely doing the exact same thing. They bought calls. They bought them recently. The CME and ICE both rallied. We can see here that those suckers were sold. So again, you could also probably guess, if you don't have access to something like this, look at the open interest, look at the stock's performance. You can see that these are in the money calls, and you can begin to get a sense of what might potentially be going on there. Okay. Next, let's have a look at Best Buy. So, obviously not in the same space. And here we are. We're just going to go to the net flow. So we can see here that there was a decent amount of open interest in the weekly, March 14th weekly 89 calls. And we have, what's the news in Best Buy? Well, Best Buy is going to be reporting earnings. Today is the 3rd. They're reporting tomorrow. Now, as it happens, in this particular instance, it's not hugely important. You can see what the net call premium, what the net premium was here by expiration. So net premium is basically whether the options are being bought or sold. But the more important thing probably, as you're looking at it, is, was it calls, was it puts, that sort of thing. We can sort of see the concentration by strike. As it happens, not a whole lot actionable here, although it'll be very interesting. This is one that's worth watching tomorrow because it's yet another sort of read on the consumer. We got consumer data coming out of Walmart that was not that great. Operating performance was very good, but it was the top line that kind of was telling an ugly picture. And, the street had been looking, I think, for year-on-year 5% sales growth for Walmart, and then the company guided for maybe 3 to 4. Anecdotally, I've seen a couple stories coming out where people are saying things are seemingly fairly slow in Las Vegas. And I've heard some other, just, again, completely anecdotal stuff, but, one of my sons works as a part-time job while he's in high school to pay for his car insurance at a local restaurant, and he's telling me that not only is he seeing it as slow, but he's getting that same feedback from, from some of his coworkers over there at the restaurant. So, this is a relatively affluent area where we live in Northern California, and I can imagine that if people are hurting here, that they're very likely hurting in a lot of places. Okay, so moving on, because I do want to get to some of your questions. Let's take a look at, and again, the reason I'm doing this is because I really I feel like a little bit of repetition and rote is going to be helpful. So here we can see Okta. It's the May 92.5 calls are the most active. But remember that this net premium number we're seeing here is basically aggregating that information. So then we can go down here and sort of get a sense of what's going on, what strikes, and where. So as far as the upcoming catalysts for Okta, we have their earnings today. And let's see, did they give us those results yet? Let me see. Because we should have had, was expecting to have that at the ready. Yes. Okay. We got it. So, at least by the Bloomberg consensus. So the Bloomberg is taking data from a lot of the analysts. There are different sources of consensus data. The way I'm seeing it right now, it looks like about a 4-cent beat, which would probably sound good. But let me just give you some statistics and we can kind of think about whether or not that seems really positive or not. So over the last 4, I'll just look at the last 8 reported quarters, and I'll go from the most recent to the most distant. Q3 25, which was actually reported last December, company reported 67 cents. That was a 14% beat versus consensus. It was an 18% beat the prior quarter, 18% the prior quarter, 23.5% the prior quarter, 45.7% the prior quarter. And if we go all the way back to May of 23, actually, that was an 85% beat. So nice that it beat, but that's not as much of a beat in percentage terms as we have been seeing. The other thing is that they are guiding to the upside, but that guidance also not quite as stellar as it has been in prior quarters. So guidance is a 6% upside surprise, but I don't see a single upside guidance surprise of less than mid-teens, like 16.5 the last quarter. And that's something else I would add, which is that there's a trend going on here. And that trend is that the beat is, on both guidance and earnings is sequentially going down. Now, that isn't necessarily a disaster. What it can mean, of course, is that the sell side, the street, is sort of doing a better job of forecasting what's going on. But whether they are or aren't, when everybody's sort of taking a look at what their expectations for a business are, and those numbers come in a little bit softer than maybe the whisper number, if we'll call it that, then that essentially makes a real upside move in the stock a little bit less likely, right? Okay, so let's take a look at Capri. This was another one, and actually Capri Holdings is probably another one to think about in terms of the potential as a sort of a look into what's going on with consumers and so on. So not really a whole lot on the calendar here until their next anticipated earnings, which is going to be coming out on May 29th. At least that's the Bloomberg estimate for their next estimated earnings. We can see here that the most active options are relatively short dated. And, we can see that there is some net call buying here. So no really obvious specific catalyst per se on the horizon. So as we take a look at it, what's actually going on here is that Capri, which owns Versace, is apparently looking at potentially, there's a deal between Versace and Prada, which I'm sure people I'm obviously familiar with the Versace brand and the Prada brand. I'm not much of a shopper myself, but this is a name that has been in play now for a little while because they've been trying to do a deal. Things kind of got a little bit messy there, and now it looks like they are going to be able to. This is different than what they were trying to work on before, but they may have a potential sale of Versace to Prada. And so that was viewed to be a positive, and that's the reason for what we're seeing there. I'm only going to go through two more just as we work through this, just again because I feel like rote is important, and I feel like I do a lot of talking sometimes and not as much showing as I should. So now we're looking at GitLab, and again, just quick things to look at. We're looking to see whether these were bought or sold. Was it calls or puts, opening or closing? And the most active options are the weekly 55 puts in GitLab. 3,800 contracts almost traded versus 254 open interest. So number one, we know it's opening. Number two, we know it's puts. Number three, we know it's short dated. So the next thing to take a look at is this based on some immediate news that just came out. What it was basically going on here is that we got some disappointing news out of them, but they announced earnings today. The number, so kind of an ugly situation. Stock obviously was kind of hard hit. When you see this kind of flow, then this is another important thing here. You can see that this flow, and this is local time for me, so I'm on the West Coast, as probably many of you know. So if you see 12, this is actually late day activity. But their revenue forecast missed the estimates. And so that's kind of what we're going on. Right now, the company is seeing revenues in the neighborhood of 936 to 942 million. The estimate, the consensus estimate, the average basically of everybody's projections was 942.6, so just outside the high end of their guidance at this point. And let's see here, one more, and then we'll get to your questions. And actually, I was going to bring up something else about that, see how everybody feels about it, because we were asked some questions last week. So, what did I do here? I must have, sorry, I put that in wrong. That was not supposed to be CDR. Sorry. That was supposed to be COR. So we're looking now at Cencora. And again, and the other interesting thing that's going on here is that sometimes you're going to be seeing unusual volume and some moves that are not consistent with what's going on in the market. S&P down over 100 handles. Actually, is that where it actually closed? I'll have to take another look at that. But Cencora was up 72 bips today. Obviously, a good day. Opening activity on the March puts is 250, 240. And actually, we could take a look. It's probably a something like a put spread. Let's take a look at what's going on in the calendar here for Cencora. By the way, when I do these types of things, I'm generally going to be looking at. So they have their annual general meeting. That's going to be Thursday. So the company is holding their annual general meeting on Thursday. Then they are going to be participating next week in the Leerink Global Healthcare Conference. And these are the types of things that can frequently move stocks. So again, and that's one of the reasons you want to look at unusual activity. So things I like to look at the term structure, which I've previously shown you guys, because it tells me that the options market sees something on the horizon that maybe I might have missed, right? So you can see that in implied volatility data, and I'm actually just going to show you really quickly what that can look like. I haven't even looked at the term structure on this one yet, but I want to point out that unusual options volume and activity can also tell you that. So take a look here. We're just going to get rid of this. And what you're looking at is you can see clearly that the options market is anticipating, some event here with higher volatility. This doesn't have weekly options, so it's, only has a handful of expirations. But looking at unusual volume, I don't recommend just blindly going in. You see calls trading, so you go out and buy calls. First of all, figure out whether they're opening or closing. Figure out whether they're purchased or sold. And finally, go and take a look at what they're likely looking at. Because if it's short-dated options, it's quite likely that you're going to be able to find an identifiable catalyst. Okay? So anyway, let's get over to some of your questions. Oh, somebody has a trade in Okta. Okay, yeah, there you go. PC does. So first, we're going to go to Monday Morning Quarterback. I have the following NVIDIA Jan 26, 2026 collars. And I'm going to, and then you actually put that into another question. So you have the 180, 125, the 175, 120s, and the 170 95s, and another 10 lot put on today. I should roll down to which strikes. This, I guess, one of my questions is why so many? I'm guessing what happened here is collars suggest that you're long the stock, right? So a collar is when you put on a hedge where you buy a downside put and finance that in part by selling an upside call. I'm going to assume that the reason you have several different strikes for your collars is that you probably didn't collar up your whole position at once, and that you've been doing this as the stock has rolled over here. You can confirm that or not, but that's going to be my operating assumption, because I don't quite know why else one would do that, but that you probably scaled into them at various stages. Here are my thoughts on this. So first things first, let's just take a look at where the options premium, the price of options, are as we go further out in time. I could go out to that specific expiration. I'm going to get rid of the historical volatility so that all we're really looking at now is what the price of the options are. And so looking at 1-year options, I put them on over the last 60 days over time. There. Yeah. As I imagined you probably did. So one of the things we're going to be interested in, whether we simply use collars or whether we add a little bit of nuance and say put on something like a put spread collar, there's going to be a couple of things that are going to start playing into that. One, whether we think there's a lot more damage to be done, right? So I'm going to put the price. Let's put the price of NVIDIA in here too. I'm just going to throw that up on this chart as well. Because the stock has already fallen quite a lot, right? As we can see here. So, oops, I didn't even go down far enough. Let me delete that. There, okay. So from its highs, we're down over 20%. Okay, so that's the first thing, is that we want to take into context when we put this type of protection on, how much further we think the stock could potentially drop net of the decline it's already experienced. The other thing we're looking at, of course, is how do we feel about the price of the options, right? So the options, when you put these things on, were relatively cheap. And when you put on a collar at, say, 0 cost, so you sell an upside call and you buy a downside put, you aren't making a volatility bet per se. You could be putting that on at something very close to what we call vega neutral, meaning that if implied volatility for that expiration rises or falls, all else equal, you may not experience much of a P&L swing. Now, as you can maintain that as your approach, so we can see that implied volatility going out a year is now higher than it was. So you could say, you know what, I'm still not going to make a bet on implied volatility one way or the other. As you can see, it's been substantially higher. It was last October here, got up to close to 60. But I want you to keep an eye on that, because had you put on a collar at that time, you might have considered putting on something like a put spread collar so that you become net short options as a result. That way you have some short delta from your put spread collar. You're short an upside call and you're long a put spread. That's a short delta trade. Not as short necessarily as a collar where you're long the put and short the call would be, because the short call is going to have its short delta, and a long put's going to have short delta. A long put spread, is going to probably have a little bit less short delta, especially a longer dated one. But we're getting into a situation where you're going to want to consider the fact that the stock has declined, so some damage has already been done. If implied volatility goes up a little bit more, you might want to consider using a put spread collar, because a funny thing happens. The impact on the value of an option of the amount of time to expiration and implied volatility are similar. So, for example, the value of the put spread, the delta involved, is actually going to shift as implied volatility rises and falls. And so if you think that you're in an abnormally high implied volatility situation, being net short options in a stock that's already been damaged might be a way to approach the problem. Let's take a look at some examples here, and I'm going to pick one of your middle ones, and we'll compare and contrast it so we can get a sense of what's going on. All right, so let's see which ones do we want to take a look at here. You have the 170.95. We're at $1.14. What's the next? Okay, so those other ones are in the money. You may want to consider adjusting those. So this is also an important concept. If you're a long stock and you have a 180, 125 collar on, that's synthetically the equivalent of being long the 125, 180 call spread. And I'm going to illustrate that first for everybody because I think it's really important to have your synthetics completely in mind when you construct these things. So let's just take a look at that really quickly. So I'm just going to take a look at, first of all, a long stock position. So we'll toggle this over. Okay. Long stock position, everybody knows what that looks like. 45-degree line that goes from the lower left to the upper right. The stock rises, you win. If it falls, you lose. Simple. Okay. Now you have that position and you say, well, I'm concerned about a decline. So what I'm going to do is I'm going to put on a put to protect my downside, and I'm going to sell a call to finance it. All right. So let's take a look at what happens when you do that. So we're going to sell a call and we're going to buy a put. Now, for this particular illustration, it doesn't really matter what expiration I'm going to choose so that you can get a sense of what this looks like. It only matters that this is what we're going to do. So I'm going to just pick, doesn't really matter. I'll just choose the 100 strike put. The 100 strike put is give or take 390. So I'm going to try to put this on at something close to no premium. And there we go. What does that look like to everybody? Right? That's a call spread. Looks just like a call spread. And to further illustrate this point, why don't we compare? Now, there's a little bit of a cost of carry thing. So if it's a stock that pays dividends and you own the stock, you get the dividend. And if you're long the call spread, you don't. Right? So there will always be these slight differences, and trust that there's probably no arbitrage to be had. But let's just take a look. So that was April. I'm going to go to April again. I'm going to buy the 100 strike calls. And I'm going to sell the 130 calls, which is what that is. And let's just take a look at these two trades. Look how similar those are, right? So just, they're synthetically equivalent to one another. And not for nothing, but selling a put spread is also another synthetic equivalent to that. I'll just do that one last synthetic equivalent so that everybody's kind of on side. You will often hear options market makers talk about whether they are long the strike or short the strike, and much less often talking about whether they have puts or calls. Because when you're delta hedged, every downside strike is a put and every upside strike is a call. And you are only interested in whether you're long or short it. But again, to illustrate this, I'm going to, again, choose April. I'm going to choose the exact same strikes. And I'm going to get long the same strikes in each case. All right. So this trade over here is long stock, long 100 strike put, short 130 strike call. This one is long the 100 strike call, short the 130 strike call. And this one is long the 100 strike put, short the 130 strike put. And they're all synthetically equivalent to one another. So that's just an important thing to think about. Okay. And yes, and by the way, as somebody was just pointing out, one of the reasons that I like to use options play for this is that it's really easy to do something like this. Create 3 synthetically equivalent trades, and we can just very quickly see how one is functionally equivalent to one another, excluding some of those carry cost components that I was just talking about. Okay. Now we're going to actually take a look further out in time and choose so once we know that, then when we think about these trades, if it seems a little bit complicated, like I've long stock and I've got all these different collars on, now just contemplate, well, how do I feel about all of those different call spreads? And is there another way that I might be think about playing it if I feel like the damage to the stock is sufficient, number one, and number two, that I think implied volatility is getting a little high. So let me give you an example of what that is. All right, so it doesn't really matter which one I'm going to pick. So I'm just going to go right out to 2026. January 2026 we're going to pick. Okay. And I'm going to do another quick comparison, although in this case, rather than just taking two synthetically equivalent positions, I'm going to take two positions that look a little different. All right. So in terms of rolling down, number one, the answer is yes, but roll down to what? Do you just simply take your collar and go down, move the put strike down, move the call strike down? Or do you maybe move it down to a put spread collar because implied volatility is higher and the stock is lower, and you want to give yourself more room to the upside in the case that the stock rebounds, and you think that the downside damage is mitigated somewhat by the fact that we've already had a 24+% decline or whatever it is. Let me show you what I mean. Okay, so what you could do at this point is say, and this can, there's another important point I would make here too, which is that when you use a put spread collar, you don't necessarily have to choose a strike that's so far out in the money. You're just going to get more immediate protection, but that protection runs out after time. So you're basically squeezing the balloon, deciding where you're going to get paid and where you're not. Well, let's work through this together and have a look. Okay, so stock right now, 114. Let's just say that the thing that you're really worried about is another 10% decline. We'll call it 115, so the math is easier. That's 103.5. So yeah, I guess the 100 strike puts is maybe an okay place to start, but maybe we can pick something a little higher. So we're going to choose the 103 puts. We're going to buy those, and we're going to sell another put, and we're going to sell a call also. Now this big decline that we've seen came off of 140 really quickly. Now, if it comes down off of that price really quickly, it is also possible for it to rebound really quickly. And if you roll these things down and you don't give yourself more of an upside buffer, you can end up essentially, clipping the upside opportunity a little bit. Maybe we don't want to do that. So in order to sell a higher strike call, but also minimize the amount of premium we're going to outlay, that's why we would use something like a put spread collar instead. So let's just say okay, I want to keep the 140 call now because I'm assuming it's going to run into some resistance here, which makes intuitive sense, right? People who bought it here wish they'd sold it at 140. If the stock gets back, they're going to say, "Oh, you know what? I broke even. I'm out." Right? So that's the whole nature of why you find levels of resistance to the upside. People who had bought badly before, when they are given an opportunity to get their money back, very often they will race for the exits. So we could imagine that there could be some potential overhead supply up and around the 140 level. So we're willing to sell that call, anticipating that now, okay, so we could actually, and you're going to see how much more headroom you can get. If I said, okay, well, I want to buy the 103 puts, and I'm going to sell, let's say I think I'm concerned about another 10% decline from there. That takes us down to, I don't know. We'll go to the 92s like this. Okay. I'm going to add stock to this so we can get a sense of what your P&L is going to look like. Well, now you're actually collecting some money on a standstill basis. You could actually either give yourself a little bit more buffer to the downside by taking these 90s. You can also potentially just bump this up a little bit. You could say, well, I'm actually more interested in this 150 area. You can start to do something like that. And if implied volatility comes in, this is short Vega. So because it's short Vega, if implied volatility comes in, you'll actually see some profits. Now, do you want to be short Vega? Well, as I was previously illustrating, What did I do with that screen? I thought I had it up. Here we are. You know, implied volatility. So this can cut both ways, right? If implied volatility, if you think it's going to get back up in this area, up to 60, if you're short Vega, then that position is actually going to end up losing a little bit of money. But I want to just put you, give some context. This expiration, 1 year implied volatility, is in the 80th percentile now, right? So this is the high that we've seen over the last year. Let's go back 2 years. Why not? And I'm going to draw a little line. I'm going to get rid of the price because it's clouding the issue a bit. So here's where we are. Has implied volatility been higher over the last couple of years? Yeah, it has been. Was in the tail end over here, and then, was over here late last year. This is not going back far enough. Should be 2 years. That actually is a little bit more illustrative. Okay. Has it been higher? Yeah, we can see it was higher over here. It was higher over here. But most of the time, it was lower. All right. So if we look at a 2 year history, what we're seeing is that this is actually in the 90th percentile for a 2 year look back. And so, and the other thing to think about is that if you're doing this to hedge a position that you intend to hold for some time, you can always adjust it. You're going to hold on to it for a while. Mean is generally volatility is a mean reverting process. It will typically revert back. That's generally true on the realized side, and it's generally true on the implied volatility side. There are real reasons why you can have a paradigm shift in vol. An example I love to use all the time is that the cruise lines like Royal Caribbean and Carnival Cruise Line, those companies shut down during the pandemic. They still had expenses. They borrowed money. The balance sheets became more levered, and consequently, you saw a regime shift. So the volatility was not going to revert back to what it was before because the equity was more levered. So you're going to have circumstances like that. But if you can make adjustments, so that's why you always have to do homework in each case, volatility is mean reverting, you would say, this is not a bad area to be thinking about getting short vol, right? And when I say short vol, this is different than just being short premium. If you sell a 3-week strangle, you're not really short vol in terms of Vega. You're short premium, you're short gamma, you're collecting theta, but you're not going to have huge benefits from a 1% decline in implied volatility. You sell a 1 year option in something like this, now you're getting into a real Vega bet, and you're taking less gamma bet. So, again, it has to do with your, what you're trying to bet on, but I would consider that. So Monday morning quarterback, I hope that helps you a little bit, and I hope that helps some. This is a broadly held stock. This is a common strategy. Things to think about. I hope that helps. So, do you trade 0 days to expiration iron condors? No, I don't. I've tried 30 deltas at the open with plans to close at 11:30 unless already filled at a profit equal to 25% of the credit received. Thoughts on 50 versus $20 wide wings. So I don't do that as a strategy. I think producer Brad, are you listening? I believe he does that. Or he does trade some short dated stuff. I'm not sure if he's able to get into my ear and tell me. I'm a little averse to selling 0 day to expiration options because, I've never wanted to be short that much gamma. I haven't minded being short gamma, short premium, collecting theta, although my best trading days came from being long gamma. I think back to Tyco. So you basically grind it out. You try to find things that look a little bit overpriced, sell those, find things that look reasonably priced, buy those, so that you end up with long and short offsetting options positions within a single stock. And then if you're long gamma and you're kind of trading that gamma day to day, and all of a sudden all hell breaks loose, you get windfall profits. And getting short a lot of gamma is a situation where you can have, the opposite of windfall profits. You're handing somebody else windfall profits. And I've never really cared to be in that position that much. So I will say this, though. I have sold near-dated options against owning longer-dated options. So I might have longer-dated strangles in SPX and then sell some near-dated stuff against it. Not always straight strangle swaps, by the way, right? So if I'm long 20 delta options out long, and so long a 20 delta call, long a 20 delta put that expires in, say, 90 to 100 days, and I'm short a 30 to 45 day 20 delta strangle, those won't be the same strikes. Unless the only time it would be, of course, is if the volatility is steeply inverted. And that would actually be kind of an ideal time to put that on, right? Because you're whatever the case is, you're dealing with a short-term spike in near-dated implied volatility, and the bet you're making is that it's overpriced and that's going to mean revert again. At the very least, it's going to come in a bit. If the term structure simply flattened out, that's a win. And if it goes back to its conventional shape, which is usually contango, if we think about it in futures terminology, what does that mean? That means longer dated implied volatility is higher than near dated. That's the normal shape. But when you get volatility like we're having now, you oftentimes will start to see this instead, which is that the near dated implied volatility is trading over. Because, and just work your way through these things when you see them. Why would this be true? Well, because right now the market's under duress. We're seeing 100-point sell-offs in the S&P. The expectation that the options market is expressing at this point is that once whatever's going on that's causing all of this choppiness is past us, things will probably start to settle down. And, we can see, what does settle down mean? Well, let's go back, let's say a month ago. Well, that was maybe not the best possible example. I'm trying to think. See if I can find a good day to go back to. It's probably going to be when the market was close to its highs. How about here? February 19th, okay? There. All right? So that's a sanguine market, a complacent market. It's a normal market, if we can call it that. And this is the normal shape of the implied volatility. This, you could show me that shape for any asset, and I will tell you that there's something unusual going on if I had nothing else to look at. Simply because of the shape of the term structure, we can tell that, right? So in an environment like this, a strangle swap as a way to be short near dated options, not a bad idea, because if you're, it's an issue of timing it, but your expectation is sooner or later things are going to, settle in at a new level and things are going to calm down, and I want to be able to profit from that. Another way to think about it too is that you could be saying to yourself, well, I want to own longer term volatility, right? Maybe here's another circumstance where you might think, if you start pushing out in time your expectations for volatility. Let's just say you knew, we heard, for example, that Zelensky was saying, oh, I'm ready to come back I'm ready to sign. That was something I read recently, as in yesterday and today. Let's say you knew that whatever was going to happen was going to get drawn out over the course of 8 weeks or so. You might say, you know what, I think this choppiness is going to persist longer than the market believes it is. And without something definitive happening in the meantime, we're probably going to chop around within a range. And therefore, I want to own 60 to 90 day options, but I'm comfortable selling 1, 2, 3 week options all along the way to help finance it so that I can own that. And then that's a good way to do it, right? So remember that as you think about what you're buying and selling, it's all going to be happening within the context of your assessment for when volatility is likely to occur. And also how that differs from the market's expectation. You can see what the market's expectation is. That's the beauty of this. It tells you, right? It's telling you that the volatility is going to revert. And this whole bit here, this short end of the curve, does this mean that we're going to chop around at, call it 26 realized volatility for, well, actually, this is really short dated. So, was that reasonable for, this is the 6th? Well, yeah, I guess that's totally believable. Because think about that. What does that translate into? So that's 2 trading days. So we could just say 125, right? So the square root of 125, 11.1. So, that's saying, do you think it's possible we get, 2% moves tomorrow and the day after? Seems a little extreme, but it's plausible. It's plausible. We had, I don't know, what was the actual move today? Let's see what this is. We'll just look at SPY. It's another potential proxy. So 1.5%, right? Okay, so yeah, let's go on to another question. Steve Garcia, Mike, do you think that the large health insurers will also be a target by DOGE? Well, they're already a target of the FTC, right? And they're also target, in the case of United Health, it's kind of a criminal investigation as well. And do I think they're going to be potentially targeted by DOGE? I think, look, everything's on the table where DOGE is concerned, but I don't know to what extent. Well, let's take a look, right? So I don't know how much of the billing problem. So basically that's already underway. The issue that's being investigated is whether Medicare Advantage plans have been overbilled. And I saw some allegations like 20%. I mean, that's a huge thing. So, and I can promise you that is an area of potential cost savings for the government that will find bipartisan support. And if it doesn't find bipartisan support, whoever's not supporting it is in the pocket of the insurers. There could be no legitimate explanation for wanting to root out overbilling in things like that. So yes, I think it's on the table, but I think it's on the table for more than just the Department of Government Efficiency, right? It's on the table for everybody, I hope. And if you have a congressperson and they're saying no, we think that the insurers should be billing even more then vote for somebody else. Mike, I have an Okta strangle swap. Bought the June 97.5 calls on the 75 strike puts. Sold the March regular way 77.5 puts. And the April 97.5 calls. Okta after hours is par. Is trading 100. What is the max I can get? What is the max I can get for a June, April 97.5 call calendar? What's the max I can get for the June, April 97.5 call calendar? Well, let's take a look what's going on here. This is the structure of the so how much you're going to get. So you're looking to sell it now. You already own it and you're looking to sell it and you're trying to figure out how much someone will pay you for it, I assume. what we can do, this brings up an interesting point. So there are some questions, and there was a credit spread question that came up last week, and I realized that I think we're probably going to have to start breaking questions into two categories. The more complicated questions that are going to require, number one, more analysis, but probably require me to put together a couple of slides so that I can illustrate it in an efficient and comprehensible way. And then I would like to do that, and we're trying to come up with a way to do that. How do we take questions where we can put together a couple slides and get them back out, in time for the next live stream? Oh, next live stream we're going to have Brian Stutland on from Equity Armor Investments. He's a former VIX options trader on the CBOE, colleague of mine from CNBC. So on Wednesday, we will have him, and don't forget we're going to have Dark Side of the Moon and Mark Guthner talking about crypto on Friday for our 2 o'clock one. Okay, so things to think about here, right? So we've got news out in Okta. We know that. This structure is going to shift. So if you are long the Junes, that's these, and you are short April, that's these, what our expectation is after the news comes out, that you're going to go back to a term structure that is going to look more like, let's see if we can do something like this. This front end is going to come down, right? And if you're trying to sell your calendar, you want that thing to actually go to a nice smooth contango where the longer dated Junes that you own are trading at an implied volatility comfortably higher than the Aprils that you are short. If you're trying to estimate what that is when you have a catalyst, what you're really trying to do is estimate what we call the vol crush, right? What is the vol crush? The vol crush is how much implied volatility falls between the moment before an event takes place and the moment just after. So in the case of the April options, if it's April regular way, here we are at the very beginning of March, you're looking at 7-ish weeks options or something like that. Why don't we call it 2 month? And the reason I want to do 2 months is because it makes it relatively easy to illustrate, okay? So what I'm going to do now is I'm going to say, okay, well, what does 2 month implied volatility behave like when earnings come and go, which is what is happening here. So let's just go back 2 years and we'll have a look. This is an illustration of 2 month implied volatility crush. All of these humps correspond 1, 2, 3, 4, 5, 6, 7, 8 to the last 8 reported earnings quarters. Our question is, what's going to happen here? Well, not too hard to guess when we can see how this typically goes. So, oh yeah, so good point. Where's my thing here? Did I close unusual whales? Yeah, because I like I said, I should promise to do this more often. I promise to do it all the time, and I need to be reminded all the time that one of the things we care about is trying to get you guys to look at things using tools that are more accessible than a Bloomberg terminal. And yeah, for what it's worth, I too am very interested in doing that, because it gets to be a little ridiculous if you are using a tool that costs that much. Okay, so and actually for illustrative purposes, this is also, I think, somewhat helpful as well. The short version of all of this is that you could go back 1 year. That's sufficient. We saw that. You can basically take a look right here, right? So I don't know whether your brokerage almost certain, a lot of brokerage platforms, the better ones, are probably going to have mechanisms to do this. But if they don't, then you can buy a tool like this one. And so this is what you're looking at, right? So it's not the implied volatility a rank so much that you care about as the percentage by which it's going to drop. And so here, I'm going to get rid of realized volatility because we don't really care about that. The stock price isn't hugely relevant either, so I'm going to get rid of that. So you can just see here, you're dealing with 60, 60, 60, 60, and what does it fall to? Wow. It's actually, this one experiences a pretty big vol crush. So 32, 32, 32. All right. See what I'm getting at here? That's what's likely going to happen to the near-dated April options, is that their implied volatility is going to fall very close to if and you can see this. I mean, it's not too difficult when you look at a chart like this to get a sense of what's going on. The implied volatility rises once it encapsulates that event, and it falls once the event has come and gone. So that is the way you can kind of think about. And yeah, I guess that's the short version, right? So if you're trying to estimate how much it is, now remember, we're showing how much that implied volatility is going to fall. It's going to matter, the near dated stuff is going to fall more, the longer dated stuff is going to fall less, and the stuff that captures subsequent events is going to fall much less. So when you're trying to figure out how much the value of that option is going to fall, and let's just pick one, doesn't really matter. What you're interested in is you take the implied volatility, you take the Vega, and then you plug in what you think is going to be and you said it was April, so we'll just go there, and it was the 97.5 calls, I think, that you were looking at, so that's there. And then we take a look at the volatility, and it's 11.3 cents. So we can see that we're looking at an implied volatility drop of, let's call it 32. So you're looking at 23. Now, by the way, Vega also changes as a function of changes in implied volatility. So this is not perfect math, but it's back of the napkin types of stuff. But simply say to yourself, I think this is going to fall 20 vol clicks, and I'm going to just call it a Vega of 10. So, 20 clicks of vol times 10 gets you to, a number. That's $2. So that would take a $3.20 option down to $1.20. Again, round numbers, but that's the way to think about it. And that longer dated one that you own is going to fall much less. It has more Vega, as we can see, right? So one had about 11 cents, maybe a little bit more. This one's got 18 cents, maybe a little bit more. But this vol isn't going to fall as much because it captures that subsequent event. So, what's this one going to drop? 5, 7, something in that neighborhood. So, all else equal, what are you going to expect to make overnight on that trade? Again, all else equal, if the stock ends up right where it is, which is oftentimes not what does happen when a catalyst comes and goes. But that is going to take a package that was we'll take the midpoint, 625 versus 320, so a $3 package, and that call spread element alone based on the anticipated structure. So I'm trying to think about it the way you're seeing me, but if this is the nearer dated options and this is longer dated ones, what's going to happen is the vol crush is going to take volatility high on the near dated ones and high on the longer dated ones, and it's going to go like that. So these options have more Vega, but this volatility, this implied volatility, is going to fall more, much more, is what your expectation is. Right? And so that's what you're going to profit on. So you're short Vega in these options, and they have less Vega, but the move will be much bigger, and you're long vol here. And that's the play that you're making. So what did I say? $3 in that $3 in that calendar. And I'd probably wager a guess that it's going to make 60 cents or so, 20% of the value of the spread overnight on the vol crush. Like, comment, subscribe. Oh my gosh. Wow, did I chew up an hour and 15 minutes already? Thank you all very much if you stuck around for my long-winded explanations, as always. And if you have any thoughts about more involved questions and trying to illustrate them somewhere better than me waving my hands around like Gavin Newsom, put them in, put your suggestions in the comment section for the video. We'd be very happy to have them. So hit the notification bell. Come back on Wednesday, 4:15 Eastern, 1:15 Pacific time. We're going to be joined by Brian Stutland. He was a VIX trader, VIX options trader, engineer by trading. And he is going to have some interesting insights for anybody who's interested in volatility, because he is a specialist in that area. And we look forward to seeing you then. Thanks for watching.